All right, so let's begin the show with our segment Meet Your Fund Manager, where the fund and focus will be UTI Aggressive Hybrid Fund. And we have Mr. V. Srivatsa, Executive Vice President and Fund Manager Equity at UTI AMC. Hi, good evening, and welcome to the show. We've spoken a lot about hybrid funds in this particular show, but then given the time right now and the kind of volatility or uncertainty which a new investor who has just got introduced to equity markets, in last 2-3 years must be witnessing, especially after the June 4th fall. How do you think can a hybrid fund be placed for such kind of investors? I'm talking about young investors, young professionals just entering into the equity market and have just seen a one-sided run.
Evening, Kavita. I think if you look at the hybrid funds as a construct, especially the aggressive hybrid fund, the equity allocation is between 65 to 80%. And the average equity allocation across the category would be about 71, 72%. So in this kind of a scenario, in this kind of a market, where equity valuations are trending on the higher side, there's a huge amount of volatility on the global side, either in terms of geopolitical or recession in US or Europe or rate, high rates continuing in the longer run in the global markets. So in this scenario, I think these funds are very ideally placed because we invest an average of around 70, 71% in equity, and the balance is invested in the debt. And sometimes debt runs a little bit counter cycle to equity because there's the debt or fixed income as an asset class has its own cycles. So in this current scenario where the valuations of the Indian markets are trending high in at a slight premium to longer term averages, the global markets are pretty volatile and India stands out as an outlier. I think these category of funds makes a very good investment case for people who are just beginning to make an exposure into equities. I think this kind of reduces the volatility, and also there could be scenarios where probably debt can probably make returns quite similar to equity, but on a risk-adjusted basis could be better. So we could probably be heading into those years, and these funds are a very ideal investment for those kind of investors.
So very well explained, Mr. Sri Vatsa, but I also want to understand the current composition of your UTI Aggressive Hybrid Fund. Being 65% being invested in equity, what's the kind of portfolio mix that you can explain us in terms of sectors and allocation?
We have roughly around 71, 72% invested in equity, and the balance is invested in the debt markets. Coming to the equity side, which is what is the alpha generator for the fund, or it generates excess returns. We invest about 70 odd percent of that 71% in large caps and the balance in mid and small caps. In terms of sectors, we take a very proactive approach in identifying sectors which are in the value zone where the sector has good long-term growth prospects and trading in the reasonable value zone. Depending on the valuations, we go overweight or underweight in the sector. So in the current scenario, we remain quite positive on banking, especially private banking, financial services, FMCG, as well as healthcare in terms of our top sectoral bets in the current scenario. On the debt markets, our portfolios are quite conservative. We typically invest more than 90% of our portfolio across either AAA or government securities. So we want to minimize the risk on the debt part of the portfolio.
All right. So, as we can see, as per the fund fact sheet, the top five sectors are clearly financial services, where you have 32%, oil, gas, consumer fuels around 9%, and you have IT, auto, and auto components and healthcare in for 8 to 7%. Now, talking about financial services and especially talking about banking, you mentioned weightage going on private banking. Any specific reading over there as to why you think this is going to be a zone where there are good picks for you?
Yeah, I think if you look at private banking as a space, it's not performed in line with the markets over the last couple of years. This is in spite of the fact that the last 3-4 years performance has been far superior than the previous 3-4 years in terms of better credit growth, decent amount of credit cost. We are in a very sweet spot as far as the credit quality is concerned, as well as good improvement in NIMs and largely a very good capital adequacy ratios. This is for both public and private sector banks, though I feel at the current juncture, private sector banks offer a much better opportunity. Coupled with the fact that if I look at the average valuation of the sector, it trends at around 1.85 to 1.9 times 1 year forward price to book, which is at a decent 10%, 15% discount to the 3 year, 5 year average. In fact, it's one of the very few sectors in the market today which is actually trending lower than the longer term valuations that the sector is trended at. So that I think makes a very good case to go overweight on the sector, specifically on the private banking side, where we are quite positive on.
So talking about an aggressive hybrid category, how do you also ensure that in your overall portfolio allocation, you don't go over diversified? How to just make sure of that? Because even your fund is largely tilted towards large cap in terms of allocation and equity. So how do you ensure there is no case of over diversification? Because you might also be having a pure large cap fund in your portfolio, whether an active or a passive way, or any other market cap portfolio. So how can you strategize it? Place it really well in the portfolio?
In UTI, we have various kind of strategies. So, for example, if you look at the UTI Flexi Cap, you do look at the UTI ELSS or Large Cap, they are all run with different strategies. So, the strategies which I run, which is the UTI Aggressive Hybrid, is quite different from, say, the UTI Large Cap or UTI Flexi Cap. So, I run more of what I call a relative value strategy. I focus a lot on value. So, for example, you would not find many high P stocks in my portfolio or very high level quality stocks in my portfolio. It'll be more of decent quality, but I think stocks which you can clearly identify with value. So that is a way we ensure that within UTI, the portfolios are not similar. So you may not find aggressive hybrid say similar to a large cap or to a flexi cap. That's our way to ensure that there's no over diversification here.
Also, on an investor portfolio level, how can you help them stay away from this case of over diversification on their personal portfolio level?
I think depending on the risk profile, I think they probably need to design or define their asset. What would be their broad asset classes in terms of whether it is debt or whether it is equity or whether it is gold. But largely, I think the first starting point is that. And second, again, a large would again depend on their ability to take risk. For example, if you're creating a portfolio for say a 60-year-old person, it would be wise to have a larger portfolio in fixed income. Either could be in deposits or could be in mutual funds, but maybe a much smaller share and possibly a bigger share in the large caps, because I think liquidity would be an important criteria for such kind of a people. If you go to the other end where where you're designing portfolio for a young person, say a 25, 30 years who wants to invest for the next 20 years, you could probably go to a very high share of equity and then probably focus into mid and small caps, because they may offer a better risk return profile over a longer time frame. So I think it all depends to, I think the first point is to identify the investor, and then depending on the risk profile, go in for either equity, debt. Within equity, go in for say a mid cap or a small cap or a large cap, depending on the risk that they can take at that point of time, and also the liquidity. If, for example, there is a demand for a high liquidity 5 years down the line, either you have some marriage expenses coming up or some children's education, makes sense to go in for a more liquid type of a debt product where you can get liquidity at the time that you would want.
Hmm, hmm, hmm. Any chance you can also go heavy in mid cap and small cap category?
See, roughly we have around 32% allocation to mid and small cap. And as a strategy, we have designed it that way, that we will not exceed beyond these levels. However, if for example, if the valuations are very extremely high in the mid and small caps, we may also reduce it to 20%, but the outer cap is 32%. And the reason being is that, since we are offering this to conservative investors, a profile of our investors in this fund are conservative, we don't want to take the path of having a higher share of mid and small caps because they are prone to risks, either in terms of volatility in their performance, volatility in liquidity. That's the reason why we have kept it that way.
Right, I think with that, it's time up on this particular discussion today. Mr. Srivatsa, thank you so much for joining in and helping our viewers understand
Thank
every
you.
aspect of aggressive hybrid category. Thank you.
Thank you.
On that note, let's slip into a quick break, and post that we'll be answering your mutual fund portfolio queries. So just in case you want to send across your questions, you can do that on our WhatsApp number and our email ID also. We'll be joined by Hemant Ustiki after this break. We'll be doing your life financial planning.